Did you know that the stock market can drop by 20% or more in just a few weeks, sending shockwaves through the global economy? It's not just random chaos. There are real economic forces at play that can send markets tumbling. So what exactly causes these crashes, and why do they seem to happen out of nowhere? Let's dive in and uncover the economic theories behind stock market crashes. Welcome to Factful Finance. Today we're diving deep into one of the most complex, yet crucial aspects of financial markets: stock market crashes. Whether you're a seasoned investor or just starting your financial journey, understanding what triggers these catastrophic declines can help you prepare and protect your wealth. Now, you might think that crashes are just a result of panic or irrational behavior, but the truth is far more intricate. Economists have long studied the factors that spark these massive drops, and in this video, we're going to break them down in a way that's easy to understand, backed by theory, and enriched with real-world examples. Let's start by discussing one of the key theories: economic bubbles. Imagine a balloon slowly inflating. At first, everything seems fine, but eventually the pressure builds up so much that it can't take it anymore. The same happens in the stock market. A bubble forms when asset prices, like stocks, become drastically overvalued at far beyond their intrinsic worth. In this situation, investors start buying because everyone else is buying, creating a frenzy. But when the market finally realizes these assets are overpriced, panic sets in, and the bubble bursts, causing a market crash. This phenomenon was vividly seen during the dot-com bubble of the late 1990s. Stocks of internet companies skyrocketed despite little to no profitability. Investors were caught up in the hype, pushing prices into a dangerous territory. And when the reality set in, the bubble popped, wiping out trillions in wealth almost overnight. But bubbles are just one part of the story. Another significant factor behind market crashes is economic imbalances. This includes issues like high levels of debt, trade imbalances, and credit booms. When these imbalances reach unsustainable levels, they create a powder keg, waiting for the right spark to set it off. Think about the global financial crisis of 2008. High levels of mortgage debt, risky lending practices, and poor regulation led to a catastrophic collapse of the housing market, triggering a worldwide recession and a massive stock market crash. Then there's liquidity crises. The stock market relies on liquidity, the ability to quickly buy and sell assets. When this liquidity dries up, the market can't function properly, leading to rapid declines. One of the best-known examples of this is the 2007 to 2008 financial crisis, when banks were no longer willing to lend to each other, creating a freeze in the credit markets. Without that credit, businesses couldn't operate, and investors lost confidence, leading to a sharp market downturn. And what about psychology? Investor behavior plays a huge role in market crashes, as emotions like fear and greed can take over rational thinking. Herd mentality often leads to market bubbles, and once the first signs of trouble appear, investors panic, leading to widespread sell-offs. This domino effect amplifies the crash, as seen during the Great Depression in 1929. At its core, this is what we call a feedback loop. Negative news spreads quickly, causing even more people to sell their shares, making things worse. Theories aside, let's talk real-world impact. Look at Olivia's story. She had been investing in tech stocks during the 2020 boom, watching her portfolio grow exponentially. But when the crash hit in early 2021, she lost nearly 30% of her investments in a matter of weeks. Despite doing her research, she didn't foresee the economic pressures building beneath the surface. Olivia's story shows how even well-informed investors can be blindsided by external factors. So, how do we navigate this volatile landscape? Risk management is essential. Diversifying your investments, setting stop-loss orders, and having a long-term strategy in place are just a few ways to protect yourself from unexpected downturns. Henry, a seasoned investor, used these strategies when he saw signs of a market slowdown. By reallocating his portfolio to safer assets, he managed to protect his wealth, while others around him scrambled to recover. At the end of the day, understanding what causes stock market crashes isn't just about predicting the future. It's about preparing yourself for the inevitable ups and downs of the market and developing a strategy that helps you navigate them with confidence. If you're serious about taking control of your financial future, it's time to stay informed, stay strategic, and stay resilient. Want to learn more about how to protect your investments from the next crash? Hit that subscribe button. Trust me, you don't want to miss what's coming next. And remember, this content is for educational purposes only. Always consult a certified financial professional for personalized guidance. If you found this breakdown helpful, you'll love what's coming next. Keep an eye on the video popping up on your screen. It's packed with more insights to help you master your financial future.